All right, what's going on, guys? For the first time in 4 years, the Feds have made a rate cut. This is the first step in a rate cutting cycle after a very long rate hike cycle. All right, so what does that mean for mortgage rates? It's going to give us a nice little lift on things like home equity line of credit, credit cards, auto loans. Those are going to improve. We're going to see a little bit less money in our high yield savings accounts. Those are going to get knocked down just a little bit. But what does it do for mortgage rates? That's what everybody keeps asking me. I think the general assumption is that we see 50 basis points off on the Fed rate. It's going to equal a 50 basis point movement in mortgage rates. That's not actually the case. So I'm going to share my screen with you. All right, so let's take a look at this. What you're seeing right here, I laid out a couple of things I wanted to kind of stack on top of each other just so we have a little bit better context as to what things have done in the past so we can better predict where things are going in the future. So Fed funds rate, that's in blue right here. 30-year fixed mortgage rates, those are going to be in red. All right, we're going to stack them together. You'll notice the Fed funds rate goes all the way back into the late or mid 1950s. So 1954, actually June 1st of 1954 is as far back as we can go on this. Mortgage rates, you're going to see those in the 70s right here. This is actually when we started tracking mortgage rates. So kind of the early 70s, we started to track them. All these shaded sections right here, you got these big shaded bars right here. These are economic recessions. And what you'll notice is the Fed funds rate will start to increase, right? We're starting to slow down economic spending until we hit a recession. Now the Fed's job to moderate things is to save employment. So they don't want unemployment to go out of control. They're going to start to lower. You'll see these lowering cycles. You see this over and over again, right? Every time we get a little too hot, you got to lower them back down, right? We're trying to balance it out. That's what the Fed's job is. Imagine the Feds are like, mom and dad, and the economy is the kids, and you got them on an allowance, and the kids are just going out, they're spending way too much money too quickly, they're running out of funds. Mom and dad have to kind of slow down their spending habits, right? So we got to put some constraints on them. So that's what they're doing when they're raising these Fed funds rate. These Fed funds rate is actually the overnight rate in which banks will kind of lend money to each other. And so if you can make things more affordable, then banks will give out more business loans. Borrowing money from banks becomes more affordable. That's why things like credit cards and HELOCs and auto loans tend to be more favorable when the Fed funds rate is lower. But when it starts to hike up, essentially what they're doing is trying to slow down those spending habits. If we make life a little bit more expensive, then the consumer will slow down their spending, right? We don't get this big run up in inflation, which is kind of what we saw coming out of COVID over here. So let's look at what it does with mortgage rates. So I'm going to try to kind of isolate this just for a second. So if we go down here, these are the Fed funds rate. You can see these big swings, very wild swings, and then mortgage rates generally follow. I'm going to kind of move my cursor off so you can see it a little bit better. Okay, so take a look at, let's just look at things over here in the 90s, and we'll look at 2000s, 2010, and so on. So in the 90s, you can see as we came down, mortgage rates followed, but they didn't follow as deep, right? You got these big adjustments here with the Fed funds rate. Oh, it's not doing it. There you go. For some reason, it likes to highlight that red. All right, if we go to the blue, whatever reason there we go. It has these big adjustments lower, but the mortgage rates generally follow direction, but they're not moving at that same dip, right? We got a big gap here between these. You can see that gap again here in the early 2000s, again in the 2010s and so on. We had a big gap here in 2020 as well. The general direction's better as rates started to move up. This is that hiking cycle, that really painful hiking cycle that we saw coming out of 2021, going into 2022 and 2023. We raised the Fed funds rate and mortgage rates moved as well. So they correlate, they follow each other, but not exactly to the penny, right? We see 50 basis point movement better. We don't see it exactly in mortgage rates. You can see that actually here. If I kind of click over and I show you this chart, what you're looking at is mortgage-backed securities. Remember, this is inverted. So over here in July, this is higher mortgage rates. Right now in real time, this is lower mortgage rates. A lot of you have kind of been aware that mortgage rates have gotten better over the last month. You can see that right here. You can see the improvement. Actually starting beginning of August is when we first had our nice little step up for better interest rates, better pricing. And then we kind of moderate, we get a little bit, we trade sideways, and you can see what's going on here. So in real time, mortgage rates are actually getting a little bit worse. They're not getting really bad, but we're seeing a little bit of a sell-off right now. They're not up here. If they were up here, this would be much better in rate. They're actually falling a little bit below this. What we don't want, you can see this trading range. I don't know if you can see that on the camera or not, but there's a little candlestick right here, and then there's kind of this big fat one right here. This is your trading range for the day. And then we have this line of support right here. This is at 101.52. What we don't want is we don't want to close below that. That's our support line. If we can stay above that, that gives us indication that we have some room to touch these resistance lines that you can see here. And these trace all the way back years. And it's basically what traders are looking at to determine whether or not there's going to be some more movement in the pricing here. So long story short, generally speaking, mortgage rates, again in red, Fed funds rate in blue, mortgage rates will generally follow. So as the Feds reduce rates, mortgage rates are going to come down, but they don't come down the exact same amount, right? So be careful. There can be some swings. You can see if we go back into this, there are sections of time where mortgage rates ticked up a little bit, specifically right here. You can see that, right? Feds adjusted rates a little bit. Mortgage rates actually went a little bit higher, a little bit quicker. So watch it. I think we've got some good rates right now. They've improved a lot. We're kind of out of that 7.5%, 8% window, which is where things have been at for a while. They're back to where levels are that make things a lot more affordable, especially for people that are first-time buyers. This is a good window of opportunity to get into the marketplace. If you are a move-up buyer, you still may have too much of a gap. So if you had a 2 or 3% mortgage rate and you plan to sell that home to buy the next house, use all those proceeds to get into your next one, it's still a pretty wide gap for you. So the cost of the new money versus getting rid of that old money on your mortgage payment, it's going to be a pretty big step up in order for you to make that move. It's not impossible. Sometimes you've got other debt that's saddling you and soaking up some of your earnings. And so maybe using that move to consolidate some of the debts, make life a little more comfortable. Maybe you carry a little higher mortgage payment, but you've gotten rid of a bunch of consumer debts that have sort of ballooned on top of things over the last couple of years. There could be a play right there. If you are a homeowner and you've gotten a lot of consumer debt, car payments, credit cards, etc., cash out refinances, especially on the Govy side of things, they're a lot more favorable now than they were a few years ago. So either a home equity line of credit or an FHA or a VA refinance is actually a really good place to start. And then as the rates continue to move lower, then maybe we refinance that again, do a rate and term refi and lock it in, and we get to a specific target price point. So that's the play for right now. Hopefully this makes a little bit of sense. Just wanted to make a quick video to give you some context around what you're looking at and what to expect. A lot of people that are waiting on their refi until the Feds have made this announcement. There's also a lot of people who are waiting on their purchase until the Feds have made the announcement. Well, the announcement's here. You can see it in real time. Rates are getting just a hair worse, not bad. It's no reason to pull the panic alarm or anything like that. But they're not actually going up here, right? They're not getting better in price. They're getting slightly worse in price. And we have some support here, so I don't anticipate them getting a lot worse from here. The general direction will be a little bit lower from this point on, but there will be some days where they're a little worse. There will be some days when they're a little bit better. That's why we have to do a little bit of planning around this. All right, guys, hopefully this helps. Let me know if you have any questions. Love and appreciate all the comments. So thank you so much for the engagement, good, bad, or indifferent. It's always fun to banter back and forth a little bit with some of you folks. So anyways, have a blessed day, and we'll talk to you soon.